Good day. This is our third part for the discussions all about exchange rates, open economy, and the likes. So this is a continuation about overvalued currency. To solve this one, it can be possible that certain financial investors will be doing a speculative run, that is to avoid losses. They are going to sell their respective assets or currencies or investments, specifically currencies in the foreign exchange market, thinking that their particular items like assets, currencies would devaluate or decrease of their values. So on the part of the central bank, or in the Philippines, the Bangko Sentral ng Pilipinas, but this could be very prevalent in other countries. And then in terms of exchanges, this system, this would be on the fixed exchange system than the floating or variable exchange rate system. And then for the central bank or Bangko Sentral ng Pilipinas going back, they would be having more losses as compared with the usual or the previous case or example of an overvalued currency solving by using the reserves to purchase or buy back those currencies or local currencies sold in the foreign exchange market. So how is that? We will see in this particular illustration. So the illustration shows here an extension of what we had discussed in the second part, wherein we had our E bar or dash above nom, which is our official rate. And then we have our E to the power of 1 or superscript nom, which is our fundamental value of the currency. So we've discussed this, that A or point A to B will be the loss of the reserves because the central bank would be buying or purchasing back the local currencies in the foreign exchange market. Now, because of the speculative run on an overvalued currency, wherein the panicky investors or investors in panic would be selling their respective domestic currency assets to the foreign exchange market, thereby more available assets or investments or currencies in the foreign exchange market, and moving or shifting to the right the supply curve from S to the superscript of 1 to the superscript of 2. And in this case, the central bank, in other words, would be losing more because from point AB, it will be now at that AB plus the BC. So overall, that is from point A to C. This will be the loss of reserves now because of the shift of the supply curve again from S superscript 1 to S2. And then we can see also that our demand curve or D has been extended further. So our new E nom, which is the power of 2 now, will be this particular point in red. So this would be our respective fundamental value of the shares that is shifted, or fundamental value of the currencies shifted at the bottom. This more rapid loss of reserves as being shown here may force the central bank to stop supporting the overvalued currency and to devalue it. This is really true. So we can see that it went down. The it is the fundamental value of our currencies, confirming the market's expectations. So the market would expect that the values would decrease further. Therefore, that happens because of the situation of speculative run. Now in figure 10.12, we can see here the currency values in the East Asian crisis from May 1997, that's May 1 to April 30, 1998. And we can see the fluctuations or the sharp movements, depreciations, in fact, as reflected in the speculative runs or attacks, in which again, in speculative runs, the panicky or in panic investors or owners of currencies would be selling their respective owned currencies to the foreign exchange markets, thereby increasing the supply in such markets. Moving on, so how to support an overvalued currency? We've discussed devaluation in speculative run. This one also have stronger or impose stronger or strong restrictions on international trade and finance to be able to maintain a certain level of domestic currency and make a policy change to raise the fundamental value of the exchange rate. So that is through monetary policy. We're in monetary policy, we have to use the money supply factors in order to move the prices or the nominal exchange rates of our currencies as well as the real exchange rates though. And then also the monetary policy would be talking about the interest rates. So those two items that we've discussed in parts 1 and 2 with respect to the exchange rates, whether nominal or real, and the interest rates, parts 1 and 2 respectively again. Then undervalued exchange rate would be the opposite. So this would mean that our officially fixed value is lower than the fundamental value of the exchange rate. If we can recall with the overvalued, we have our respective official value or fixed value. In our overvalued, our officially fixed value is basically higher than the fundamental value. But in undervalued, which is the opposite, so our officially fixed value is lower than the fundamental value. So in this case, that's why you can say it is undervalued or not valued properly because the fixed now is lower than the fundamental value. We can just say then that the fixed value really is what should have been the value. This is all about fixed exchange rate systems. So whatever is the fixed value, that would have been the basis. With the overvalued, fixed value is the basis, but the fundamental is actually shown in the lower part. But really, whether that's overvalued or undervalued, our basis would be the amount of the fundamental value to be maintained. So we will see that in the illustration later on. An undervalued exchange rate could be maintained indefinitely if a country trading partners would not lose their reserves, which is true though, because there would be gain on reserves in undervalued. How is that? In the next illustration, we can see here again the amount of currency on the x-axis, the nominal exchange rate on the y. And then we can see here the fundamental value with E superscript 1 norm and then E bar norm, our official rate. So why is this undervalued? It's because our respective official rate is actually lower than the respective fundamental value. So the official rate is our fixed rate or the fixed value, as opposed to overvalued, wherein our official rate is on top of the fundamental values. Official value is our fixed, which means that actually our real value, which is fundamental, is actually lower than our fixed. So that's why it is overvalued. But this one, this is the opposite. Our respective fundamental value, which is the real value, is higher than the official rate, or the opposite. So official rate is basically lower than the fundamental value. Therefore, it is undervalued because fundamental value is in essence really what is our basis. So official is the fixed. In this case, to maintain the exchange rate at its official level, which is our official rate or the fixed rate, the central bank must supply its own currency to the foreign exchange market. And that's the reason that there would be lesser available domestic or local currency in the local market, thereby increasing the price. So that would maintain. And in that case, there would be gain on reserves because in the economy, lesser currencies available. So sale only of existing supply, and therefore with the lesser available supply, there would be lesser reserves. In discussions of monetary policy, the banks would be maintaining a portion of their respective resources for reserves. So just in case there would be some emergencies that would happen in the economy, then such would be using that. So that's the point of undervalue. Then in a monetary policy, which is a policy being used by central bank or any central bank of any country, and then which would focus on interest rates again and the money supply. Under fixed exchange rate, the central bank cannot use monetary policy to pursue macroeconomic stabilization goals. So the overall stability of the economy cannot be pursued by using monetary policy under fixed exchange rate system. Then in this illustration, we can say the money supply or M sub 1 being shown. So if this particular horizontal line official rate or our fixed rate and then the fundamental value downward sloping, so this shows that for fundamental value, a higher domestic money supply causes a lower fundamental value of the exchange rate, which is true because there is more money in the market, therefore the values, the real values will be going down, but the official will be fixed. So we can see here, we can realize here that at this point, so just before M sub 1, if we can just extend the broken lines, our fundamental value is higher than our official rate. Therefore, we can say it is overvalued. And that's why, again, we can say that there would be losses because we need to buy back our respective currencies in local currencies again from foreign exchange market. So the reason is for us to maintain our respective official rate and then or the fixed rate. But if we go beyond the M1, this is the point where we become actually, by the way, this is somehow the opposite actually, right? So we continue. So in the previous illustration, rather, that was for undervalued. Let me repeat and continue with the discussions first with the overvalued, because this is the first one that was mentioned. So for the overvalued, we can see that when the official rate or the fixed rate is higher than the fundamental value, then there is overvaluation. The question is why? Remember, our official rate is again the fixed amount, and then the fundamental value is really the value. So we can say that even if the value really is lower, and then the official rate, which is the fixed one, is higher. So this means that the official rate is overvalued relative to the fundamental value. So again, this is the case of the loss of reserves because the economy in representation of central bank would be buying back the respective local currencies from the foreign exchange market. I mentioned that a while ago, but again, that's overvalued. For the undervalued, our official rate is fixed, but then the value really is higher. So that's why you can say that it is undervalued. The it is the official rate. It is undervalued because it should have been higher. As opposed a while ago with the overvalued, wherein the official rate is fixed, the value is lower, it should have been lower. That's why it is overvalued. And the undervalued, again, there would be gain on our respective reserves for the central bank because what we are going to do is we are going to sell our local or domestic currencies to the foreign exchange markets in order to maintain our situation or case of the official rate. So we would be selling then our excess here for the undervalued, but for the overvalued, we are going to buy back so that we would be able to get back the deficiency. So a while ago, excess of fundamental relative or vis-a-vis to official. But here, the deficiency from our official relative to fundamental, or fundamental deficiency going to official. And then we can also realize that if the central bank increased the money supply above M sub 1, the exchange rate would become overvalued because we would be going, of course, higher. Official rate would be extended higher. And then a money supply below M1 would result in an undervalued currency, since the official rate would also be moving downward. All right, so moving on. What are the benefits and some important points with respect to fixed versus flexible exchange rates? In the fixed exchange rate systems, the benefits would be that in cost, less costly in terms of trade, lower transaction cost. And then we can make use of monetary policy, again, uses or with the usage of interest and our money supply. This would promote discipline. The downside is inability of a country to use its monetary policy to deal with recessions. And that's another thing or topic to be tackled in business cycles. Anyway, so in our discussions here in exchange rate system, there can be trilemma. So there can be three factors. However, in using any exchange rate system, whether that's fixed or flexible, we can only make use of two of the three features. So it's either a fixed exchange rate to promote trade, free international movement of capital, or autonomy for domestic monetary policy. The last one is independence. So we just have to utilize two out of the three. So if we use, for example, a fixed exchange rate to promote trade, then we can have autonomy for domestic monetary policy, or the second one, free international movement of capital. For the fixed exchange rate system, this is useful when used in a group of countries wherein they can have large benefits from increased trade, buy and sell, and integration of such to the economy. And then monetary policies can be coordinated closely. A while ago, we've said about undervalued, overvalued exchange rates, and then we can make use of that to be able to analyze what happened in the economy and make use of monetary policies accordingly. Now, for the flexible exchange rate system, this is useful if a country has specific macroeconomic shocks or certain disturbances to the economy as a whole. And then by then, we can make use of the interest and money supply to reduce the impact of those shocks. Monetary policy, once again. For currency unions, this is a sharing of a common currency by a group of countries. Example, we have the European Union, wherein there is euro as a currency being utilized by the members or groups of the union. The currency union would reduce or reduces the cost of trading and prevents speculative attacks on currencies or runs. So there is regulation in the currency union by then. However, if there are monetary policies, they cannot be done independently or cannot be done or cannot be independent because the monetary policies are shared and followed by the members of the group. So there is a monetary policy, or there are monetary policies for the union. Then for self-correcting small economy, these has more sources, or it has more sources of unexpected shocks. However, there is a correcting mechanism in addition to the price level. We can adjust the exchange rates in order to help for correcting and helping a small open economy from sources. As being discussed, open economy is where we can see again globalization for the trade and also for worldwide scale or level when it comes to exchanges of financial assets or investments. Then for self-correcting economy or small economy, to be more specific, in a fixed exchange rate system, the fiscal policy, which is a set of the policy or policies coming from our government. So in terms of taxation and government regulations, Such would neutralize because it is more on monetary policy, and then shocks on the investment and supply curve. So that would iron out investment and supply because we are focused with the currencies. On another hand, monetary policy and shocks to the LM, which is the liquidity preference on money. Take note, this is all about currency, so money is really important. Curve have a magnified impact. IS and LM is based on Keynesian concept or set of concepts. Anyway, will not be discussed here. Then in a flexible exchange rate system, such would neutralize or neutralizes monetary shocks, impact on the monetary items and currencies, and as opposed to fixed magnifies effects of the fiscal. Let's go back. So take note, fixed would neutralize the fiscal, no impact to the fixed exchange rate system for taxation and administrative and government regulations, but for the flexible, such can really help. And that will be the end of our presentation. Thank you very much for listening. God bless us all. And thank you once again for bearing and staying with us for the 3 parts of these lengthy discussions. Thank you very much.